Welcome back to It's a Numbers Game. I'm Adam Morris, joined by my co-host Daniel Welling. Today we are talking about one of the biggest topics in the MSP industry right now, and actually one that we have talked about several times before. But it's a really important topic and is always relevant. We're talking about mergers, acquisitions, and what the market actually looks like in 2026. There's been huge consolidation over the last few years. Private equity continues to shape the sector, and now AI is beginning to influence both valuations and service delivery. So whether you're planning to sell, scale, acquire, or simply understand what's happening in the market, this is a conversation worth listening to. So joining us today is Paul Vanstone from Equity MSP. Paul works closely with MSP founders, investors, and acquiring businesses across the sector, and he helps owners understand not just how deals happen, but also how to prepare properly for them. We cover the state of the market, the different types of buyers out there, what makes an MSP attractive for acquisition, and why planning early matters far more than most owners realise. So let's get into it.
Paul, welcome to the podcast.
Great to be here.
And Paul, we met, well, only a short time ago, but we actually met through one of a client in common on the topic of M&A, and we'd not come across each other before, and it's been very enjoyable getting to know you and chatting all things MSP M&A. So we wanted to share with our audience perhaps some of the highlights of what we've talked about over the past few months. And perhaps we could start with a bit of a finger on the pulse in terms of what you see 2026 being like for MSP M&A activity.
Well, thank you. Thanks for inviting me onto the podcast. I think it's been an interesting period from an M&A perspective, and perhaps at a bit of the backdrop to it, and perhaps hopefully echoes of what you see. We've obviously come from a 5 or 6 years of heavy consolidation. A lot of PE funds have come into the market and sponsored or backed platforms, and there's been very rapid consolidation in the space. Some very well-known ones who've made double-digit number of acquisitions. Some private companies have been in that sphere as well, doing the same thing, self-funded. And then you've also had some new permanent capital vehicles coming in, which are a little bit different. And there are still new people who want to get into the market. And that interest historically, I think, the market had a lot of attractive dynamics to it that drew that capital in, a combination of just inherently being a very fragmented space. A lot of the businesses had grown up from sole traders effectively to spun out of doing support or set up doing something themselves and grown organically over the last 20, 30 years. And there are thousands in the UK, north of 10,000. Many of them have less than 10 people, but there's a decent number out there that are of transactable size or acquiring size or size that can get backing that have 20, 30, 40, 50 people in there. Decent businesses that have grown well and a lot of attractive dynamics about them. And you couple that with a market that certainly, last 5 years has been experiencing a number of growth drivers. There's been that move to cloud in the end client base, in part driven by security and efficiency. There's been that's emergence of the importance of cyber. The working habits of people have varied as well, working from home, COVID, so that's required some investment. Inflation has driven through price increases as well. So you had almost like a perfect storm that's really pushed that market through, both on the sell side in terms of fragmented market, people wanting to realize value, and then on the buy side, just attractive dynamics look outside, looking in. And a lot of that still remains in the market. It is a good time to be a seller in the market, I think. But the market, speaking to people, both investors and operators in the space, the market is changing, and I think the bar is higher if you're a business that's wanting to sell in the market. Relying on you just being good enough, it doesn't just compromise your ability to get a strategic multiple, it may compromise your ability to transact if you're looking to raise capital to sell the business. And the backdrop at the moment is one of that organic growth in the market is slightly tempered by just wider economic headwinds. Price rises are far lower. AI is beginning to drive efficiency in the service provision, but in turn, that is also beginning to put a little bit of fear of rate pressure coming in into sort of what you can charge people for support. If quite a lion's share or quite a degree of that first line support can start to be augmented with AI, there is a concern of people coming into the space that actually that's going to be quite disruptive. But still on the positive side, you've got AI coming in and your customer base, they need to be educated around that, and you can help drive value through that by being a strategic partner with them. If you deploy AI from a service delivery perspective, you can at least protect margin. If you do it well, hopefully enhance margin. Cyber is obviously important. There's been some, very well publicized big corporate events around that. I mean, frankly, if you don't take cyber seriously as an end customer, an SME or a medium-sized business, you aren't really putting yourself at significant risk and your customers at risk. So that is, driving demand in the customer base. And there's still a decent number of acquirers out there that are looking to consolidate and acquire owner-managed businesses serving the SME market. And they remain the same types, PE-backed trade, privately funded vehicles, which are companies that are looking to increase scale through acquisition, and the hybrid capital types. And then there are new pools of capital looking to come in who wouldn't be household names to people because they haven't actually done a deal yet, but they've got significant backing there. And their investment thesis tends to be quite AI-centric. So taking old school MSP, overlaying AI capability, and being ahead of a curve in terms of where the industry is perhaps heading.
One of the most common conversations I have with MSP owners goes like this. We're busy, clients are happy, but the numbers never quite look how I think they should. And almost every time it comes back to the same thing. Not effort, not demand, but how the business is being valued and priced. And if I'm honest, it often runs a bit deeper than that. A lot of owners quietly undervalue what they do. They don't fully recognize the weight of responsibility, the experience they've built, or the impact they have on their clients' businesses. So pricing ends up lower than it should be, not by a design, but by a belief. It's incredibly common. We see it all the time. And it's something we help MSP owners work through in a structured, practical way, so the numbers start to reflect the true value of what they deliver. If any of this resonates, it's worth having a conversation. So just head over to mspfinanceteam.com and book a slot in my diary, or email me at adam@mspfinanceteam.com.
A lot to digest there, and a really good summary actually, I think, of the history and some of the current threats and opportunities. And as we were talking in the green room, let's hope no one actually figures out the absolute number one MSP secret of turning it on and off again, as that's a real threat to all of the M&A promised.
That's a starting point, isn't it? If it doesn't work, you turn it on and off. So,
Dan, I know you've got a question just lined up, but there's something just eating away at me, and I need to ask it. Paul, can you break down in the simplest language possible who the buyers are? So you came up with a little bit of jargon in there. I think permanent capital vehicle was one of them.
Yep.
So could you just break it down? You've got 5 different types of buyers. This is who they are.
Certainly, yeah. Let's start at the simple end, if you like. Ordinary MSPs that are still owned by their founders or people who've taken over from the founder, where they don't have external capital except for perhaps debt, and they are looking to just buy other MSPs. So if you're an owner of an MSP, you're looking at effectively your peer who is self-funding, who is wanting to scale up through acquisition. And they may take on external debt to do that, but they still own the company. So you are selling to another entrepreneur effectively. Evolving from that is you've got PE-backed platforms where typically an owner-manager has taken on external funding to help them acquire other MSPs and invest in the business. They may or may not have taken some money off the table when they took capital investment from private equity. That's that's a sort of a decision for them as they go in. But these businesses typically, they raise single-digit millions right the way through to, some of these deals that have gone through 2 or 3 rounds of private equity. have taken on hundreds of millions to invest in the space. And when I say 2 or 3 rounds, if you take on money from a private equity house, that partner, your private equity partner, will typically be with you for 3 to 5 years, and then they will seek to realize their investment. And if you want to continue on that journey of acquiring other businesses and de-risking at the same time, you would go to a larger PE fund and do a second round and take on more money, and they would buy out the old private equity fund. That's typically how it works in sort of simple terms. You've then got just large listed entities who are funded through capital markets, companies that list on stock exchanges that you may have heard of. And then the slightly newer capital vehicles that we're seeing are the permanent capital, the notable one being Evergreen, where they are backed by the same type of people who back private equity funds, so pension funds, and they are looking to acquire MSPs en masse, but without integrating them. So they're not typically integrating that heavily, and they're across multiple jurisdictions, but they don't have I mentioned that 3 to 5 year time frame that a typical PE fund has to realize its investment. They are a permanent capital vehicle, so they will continue going for as long as day turns to night. Now they're relatively new, so does that mean forever and ever? I don't know, but that is their sell points, and slightly different from a PE-backed trade acquirer or just a listed trade acquirer. Like I said, they don't typically integrate, so your company remains independent. You go to market in the way you've done historically, but you'll get some benefits of having some group expertise at the top co level, the acquiring level, some purchasing benefits through some of their suppliers. So they're a little bit of a halfway house, but give you that independence if you want to continue your business and keep running it, really, or you want to step back and get a professional CEO in.
And that neatly leads into my original question, actually, which was, I'm sat in the seller's seat, and you've got all of these different potential buyers in the market. Is the optimum position to try and make yourself attractive to all of those buyers, or zone in on a particular type of buyer?
I think it's a good question. And I think if somebody hasn't been exposed to M&A or haven't got close confidence who can give them the inside track, there's a danger that you want to speak to everybody and you want to get the best price, and you just go far and wide. And I always sort of compare M&A to the sort of dating analogy, online dating. You often don't know most of the people you're going to meet. You don't know who the right match is. If you try and meet 100 people and then pick your future partner out of those first meetings, you're probably going to make the wrong decision. If you can identify what a good fit looks like, meet the right 5 or 10 and spend time with them based on that, get to know them, understand if they are a good fit for you as well, you're probably more likely to wind up with the right person. So I think it's having a plan about what you want to do personally and what you want for your company. They are different. On the back of that should inform the type of buy or the type of exit route that is right for you. And then you can go on a journey in terms of engaging with those buyers at the right time. And I say buyers, I use that sort of the colloquial buyer being an investor as well, but your eventual exit partner. And the simple truth is as well, a lot of people say, well, why do I need an exit plan? I'm not going to sell the business. You're going to exit the business at one point, whether it's you're selling it, you pass it to your kids, to the staff, or something worse happens, but you are exiting. You need a plan one way or another. So, it's one of the first things I say to people who I speak with, and they sort of push thoughts of such things away because it's not on their mind, but it will be at some point. So I think it's an informed journey of working out what's right for you, and then that will inform who you speak to.
Really interesting. And of course, one of the objectives of this podcast is to help educate, inform our audience who, for many, they will only exit one and sell one business. So for many, you only get married once, and therefore, just in analogy with the dating concept. And
isn't that where it breaks down, Dan? Because actually you go through several wives. You don't just have one.
Well, it depends, doesn't it? And after wife number one, do you want to go again? And as is a term that some multiple MSP owners have used in.
Well, there's a lot of comparisons, because a lot of
Yeah,
MSP owners do go after sort of 3-4 years of being out, don't they?
Yeah, yeah. So we're in danger of going down perhaps a slightly risque rabbit hole. But for me, the key point there was that all of this takes time. So you're not just going to get up as a seller one day and say, oh, I'm going to sell the business and put 30 years, blood, sweat and tears into it. And therefore it's worth X to me. And I'm just going to go to the market and get what I want in short order. This has got to be planned.
Yeah, no, that's a really good point. And you'd be surprised, I've been doing it for advisory or on the buy side for almost 30 years. You'd be surprised at the number of times, and it's a minority, but it does happen, where an event happens either to an owner's personal situation or circumstances or something in the market that changes their mind and makes them think, I've got to go now. And so you get a desire to rapidly transact that wasn't planned 6 months in advance. And it's those ones, 9 times out of 10, it's either you have to put the brakes on and say, you're just not ready, or the reality is that there's just, 1, 2, 3, 4 sort of important aspects of the business aren't optimized. And you're kind of forced into a position of selling something that could have been better if they just planned more in advance. So yeah, absolutely, it should be thought about well in advance, even if you're thinking about an exit in 20 years' time, because life changes and the environment around you changes. And both of those things can precipitate the need to transact or a desire to transact. So even if I was starting a business myself now and plan to run it as a lifestyle business, I would still have in the back of my mind, right, well, okay, well, what is the long term? What is the journey that I want to go on? And what is the plan for when I don't want to do it anymore? Or do I have a specific objective to sell for an amount, or I want to retire at 60, want to pass it to my children? All these things all take you down different roads.
Yeah, really interesting. And the key word that I picked up there was the optimise word, because if you don't optimise what you're selling, then you're not going to optimise your the value that you're gonna get as a result. And it's something that Adam and I talk regularly about in our everyday conversations with MSP owners. So other than time, then what else would you be advising a future seller does to prepare for that optimized future event?
I think at the very crux of a plan, if you like, work out what you want to do personally as a business owner and where you want to get to. And so that might be money, that might be lifestyle. It might be that you want to start again and do something else. A whole host of things really that drive that. And also what you want for your business. And your staff, is it all about just maximizing money, or do you want your staff to be safe in their careers? Do you want the brand to perpetuate? Those decisions, or those building blocks, if you like, or the foundations of an exit plan, do to a degree dictate which direction you go in. Not mutually exclusively so, but they might do sort of inform some of the decisions that you'll make that will actually have an impact in 5 years' time, which will inform an exit. Without going into the sort of the details of each one, all the things that underpin the building blocks of an exit plan will put you in a better position for which ultimate route you take, because 9 times out of 10, most of these things just mean you'll be running your business better, and they'll give you optionality around what you can do down the line. And by having a plan, it forces you to think about these things, and it forces you to talk about them by putting them on a piece of paper or a board or with your advisors. And by talking about things and having them at the sort of front of your mind, at least periodically once a month, you'll tend to get them done rather than do something that you should do, but you just don't do. So I'd sort of preface what a good plan looks like with all of those types of themes. And I think actually by just thinking about some of those elements, you'll turn over the stone and come across things you just hadn't really considered before, because you're not asking yourself these questions on a regular basis. And by actually just thinking about it, you do explore a little bit more about what you want for yourself and your business. I think that really should come down to the sort of crux of it all. A lot of people just say, oh, I just want to make 10 million or 20 million or pick a number. But actually, the journey to get there isn't one that they'll enjoy. And that doesn't necessarily seem sensible to me at the same time as well. So I think it does make you think about these sort of things when you're looking at it.
Absolutely. And the tolerances that you have to, like, as you say, maybe the number's 10 million. Well, what are you prepared to do to get to that end result? And the planning process itself is a journey and a destination as well. Yeah. And in a lot of ways, it's more about the journey than destination. Having a perfect plan is less important compared to what actually going through it forces you to, as you say, think about things, look under stones and really ponder what you genuinely want.
And I think just on this subject, because I don't think it's talked about enough, I think we skirt around the edges of this, quite frankly. Often in these discussions, it always comes down to some kind of target, target, generally speaking, is a number. Financial target, a goal. And okay, there's some other things around what you want to do with the staff, what you want to do with the brand, all the bit. But, traditionally, the world of M&A is all about finance, numbers and returns for people, right? And risk management. And it's interesting because, this is all relative. Everything's so relative. We've got one man's 1 million is another man's 10 million, is another man's 100 million, is another man's billion. And all the research out there has shown that, the guy that's got the billion has the same problems as the guy has the million, right? He's just got different problems, But he's still the same person, same individual, sees the world in the same way as he did before. And so essentially what I'm saying is that you've got to think why, if it's 10 million or after, why is it 10 million? What is it about that number that is actually meaningful and purposeful for you? Why does it matter? And I think there's something really interesting about having some of those deep sort of thoughts and reflections around that, because otherwise you're just on this journey, maybe putting yourself in situations you don't really want to do, maybe working harder than you want to do, maybe your work-life balance isn't quite where you want it to be. These are big questions, and I think I encourage everyone to have life plans around this sort of process. And absolutely, you don't want to undercut, but be really clear why that number is important to you, because it might actually not be something you're searching for, and you get it and you realize it wasn't what you wanted all along.
Yeah, I absolutely agree with everything you said. And having been on the buy side and you spend time with people and also as an advisor, you retain contact with people, and some of my previous clients are lifelong friends. You see people going through that journey. And as you say, when you sell a company, yes, you might be involved for a bit if it's a trade deal, but all of a sudden that massive part of your life's gone. And it's an interesting journey. I don't think enough people think about that before they go into that sort of exit planning. And it's an important point. And the other, and linked to that, you did talk about, the start and the finish of a journey. I'm a great believer in, especially if you're an owner of a company, ultimately within certain confines of normality, you can do what you want. It's your company. And a lot of these successful MSPs have done well because at least at one point, certainly at inception and through the journey, right, to current point in time or up to a point, they did well because the owner did something very well. And a lot of them started off as 1, 2, 3 people. So they had to, he or she had to have been very good at one or two things, whether it's technical services or sales or winning work or new technology. They were very good at something. And as a business grows, and it gets to the point about relativity, you're in a new environment, which may not be the environment you enjoy anymore. You may be making money, but all of a sudden you're having to manage people, you're having to manage finance. You may be a technical person, but you hate selling, et cetera, et cetera. You may be a salesperson who actually hates being on the technical side. And one of the luxury that having a business does afford you is to get yourself into a position where you are really enjoying what you're doing. It's motivating you. And yes, you can, you do one of the natural things to say to owner managers is, become more strategic, step back so you're not critical to the day to day. That is true. And that gives you optionality. But if that means that you see yourself as a CEO and all of a sudden you're having to do all the HR stuff and deal with people who misbehave and don't perform, and all that is what your job becomes. But you don't enjoy that, but you still want to achieve an exit of 10 million, but that's 7 years away. Well, that sounds like 7 years of not really enjoying what you're doing. But actually, if you think ahead and think what you enjoy, you can find, or you should aspire to find the people that do things that you don't want to do because they are good at it, and surround yourself by people who are as good as you or better than you at things you don't want to do. And the best CEOs and owners I've ever met have been the ones who've done that. They've got a good team around them, and it means they've enjoyed the journey far more. And yet we're sort of drifting into the sort of, philosophical and what motivates people in life. But I think that should inform or be the foundation of your exit plan, because it will make that journey far more fulfilling.
100%. And I guess this is where we normally end up drifting into signposting people towards the EOS concept. As you say, you can end up in an integrator or visionary role, and which one best suits you, and all of that comes back to the tolerances and what your overall life plan are. So, and I guess one of the things that you mentioned earlier that I think is critical to this, and a role that we all have in common working with our clients, is that of advisory and being part of that board of assistants to working through these topics. So what advice around picking advisors, for example?
Yeah, I think you want to ultimately, the actual act of selling a business, from starting cold, like I want to sell my business tomorrow, and you don't have anyone appointed, to having completed a transaction. Reality, you're looking at 6 to 9 months, maybe shorter. But if you haven't done any prep and all that needs to be done, and then you've got to go and speak to the buyer community, go on a dating game. And then you find the partner that you want to sort of transact with, and you have to negotiate with them, and then you're into diligence. It takes time, and it is an all-encompassing period of your life. The number of clients I've had who have said that was the most pivotal point in my life, apart from being married and my first child. Maybe one of those two doesn't feature in that, but also a combination of the most enjoyable, the most exciting, and the most stressful. All of those wrapped up into one. So you've got to pick somebody. I talk this sort of base level from a corporate finance advisor perspective, because they sit across everything. You've got to pick somebody who you definitely believe is going to be there with you in the trenches getting the deal done, because you do get drawn into it, and it becomes a big part of your life, and it can be a distraction on running a business. So it's about trust. It's about their ability to advise you and their network, and their ability to really understand your business and articulate it in a way that appeals to the buyer audience, because they'll be having a lot of conversations. You will not be doing all the conversations with all the buyers. It's physically impossible. It's their job to act as a buffer between you and them as well. So find someone you can absolutely trust with, that you can see yourself being in the trenches with for 6 to 12 months, and somebody you genuinely believes gets you and your business, not just your business, but you as well, going back to the whole point about what you want out of something. I use some of those time frames sort of intentionally to sort of emphasize the point that actually look further out than just 6 to 12 months. Actually, the ideal time to sort of be speaking to somebody is, well, when you're formulating your plan, you don't have to appoint somebody to sort of formulate your long-term plan, but actually sharing that with some people who've been involved in M&A, whether it's they've had their businesses acquired, like, yourselves from an operational perspective, you've been sellers, someone like myself who sells businesses in this sector on a regular basis, and sense check your aspirations with them. So, they are realistic from an exit perspective, but also keep that dialogue going, whether it's formal, informal, so you can share your journey with somebody, because being a founder is often a lonely experience, especially if you're a sole founder. Who else are you going to talk to about, the challenges at work, strategy, money? You're not going to be talking to your employees about a lot of those things. Your wife, well, if she's interested and she understands, your friends, you don't talk about a lot of these things on a personal level. So having somebody outside the tent who can guide and just be a sounding board is invaluable, and can help give you some market feedback real time as you go. So it's both the right person, but also that person ideally should be on the journey with you for at least a few years. And I can always tell when I've worked with businesses or acquired them, it's always very obvious if someone has had proper advice, because they're far more informed on what the process, they're ready for it as well, personally, and the company's ready and it's been optimized for that. And maybe we'll come to some of the things that you can do in the run up to a sale. So yeah, corporate finance advisor, critical, that you'll really get to know them over that period of time. And then other advisors like your lawyers, definitely get a lawyer that is experienced in M&A. One of the danger signs, and I've been on the buy side, is someone's got their lawyer that they've always used to do a bit of work here and there, a bit of family law, do a bit of business law, and it just unravels. It just goes wrong because they don't understand where the market norms are from a transaction M&A perspective, and it can be painful, frankly. So a lawyer that you trust, who is, again, give you a commercial view rather than just a legal view, because that's important sometimes. Outside of that, depending on how much capability you have internally versus externally, if you have external accountants, tax advisors, you want people who they're more likely to be a long-term business partner of yours anyway. But coupled with that, you want good quality information. You want it all up to date, because all of that sort of stuff will be crawled all over come transaction time. So if you haven't got your tax affairs in order and stuff like that, you definitely get your ducks in a row on that side of things.
Really, really good advice. And I'd love to carry on the conversation and get into a bit more of the detail, but we're pretty much on our time budget. So I think what that means, Paul, is we're going to have you back for another episode, and hopefully we can organise that in the coming weeks and months. In the meantime, if anyone wants to carry on the conversation, how best to get in touch?
Yep, I'm on LinkedIn. I guess I think you've also put in my email address in the script as well. So yeah, or phone. I'm happy phone number to be on there as well. So always have a chat with somebody, even if they to the point of this conversation, even if it's 5 years away, it's always good to sort of meet somebody early on and form a relationship.
Very good. Any final thoughts, Adam?
No, only just picking up on Paul's point about working with a good accountant and finance team. If only there was a specialist in the market that dealt with that. So anyway, yeah, no, really good session today. So much to talk about, and yeah, great to have you back.
Enjoyed it. Thanks, guys.
Thank you.